Okay, so today we are looking at a very simple topic, yet one of the most important topics in economics today. So we are looking at what was it again? What did I say we are looking at?
Money.
Market structure, not money. Market structure. At market structure. So the question is, why market structure? Why are we looking at market structure today? It is just one topic in economics that either you like it or you don't like it, you usually see a question from market structure. So what we'll be doing today is that we'll try as much as possible to break it down. Everything you need to know under market structure, we'll try to break it down so that you not make any mistake. Is that taking? So what am I trying to do here? I'm trying to get my notes ready. So, but then let us start with a simple definition. Although we're treating consumer behavior the last time, but I know we can still do better. That should be for those who are in the physical class. But today we are looking at market structure. So the question is, when you are being asked what a market is, what comes to your mind? Can you tell me? If I ask you what is a market, what comes to your mind? Oh yeah, we are one after the other. If you want to answer, raise up your hand. What do you call a market? Oh yeah, you. Is a point, where buyers and sellers interact. Okay, is a place where people sell and buy.
Market is a place where buying and selling take place.
Yes, Oyibo Kono so you are still saying market is a place. But permit me to tell you that market is no longer a place. Are you with me? Market is any arrangement that allows buyers and sellers to meet to exchange goods and services in payment for money. Any arrangement, are you with me? Any arrangement that enables buyer meet seller. Are you with me? Any arrangement that enables buyer to do what? To meet seller. That is what a market is. So before we continue, please, those who are doing CBT, I want you to keep quiet. We are having a class here. Please. We are having a class here. Please, quiet. Any arrangement that enables buyer to meet who? To meet seller. So I want to quickly share this on your platform. So please do well to share it to all the platforms that you find yourself. Do well to share it. So it. Have you seen the link? So it. Have you seen the link? Have you seen the link? So please quickly share. And sorry, we will need one to help us monitor the sound. Is that okay? We need someone to monitor the sound of what we are doing. How do you do that? So you just play it. We'll be looking at it so that we know what is coming in and what is not coming. So let us start with the very first thing that we have here. Please place clearer because I want to have a space to put this. There are so many diagrams that we'll draw that I will have to explain. So the market, but now we've talked about market. We've talked about market. I told you that market is an arrangement where buyers and sellers meet in order to exchange goods and services for money. But then we are looking at market structure. Under market structure, what are those things that we are expected to know? The things we are expected to know, I'll send those things to your group so that once we are through, are you with me? Once we are through, we'll be able to, or before we are through, we'll be able to know that, okay, this is where we are and this is. So what I'm saying is we have to see the objective. Is that taking? The objectives, what we need to know by the end of the class. So under market structure, we have to know what a perfectly competitive market is. That is for UTME. Under market structure, we have to know what a perfectly competitive market. We have to know what it is. But under perfectly competitive markets, we have the assumptions and characteristics of a perfect market. Assumptions, that is the first thing we need to know under this. Assumptions and what? And characteristics, don't forget characteristics. The assumptions and characteristics. The next thing that we need to see, we have to see the short run and long run equilibrium. All these are very important. Short run and what? Long run equilibrium. That is under perfectly competitive markets. So the next, okay, long run and short run equilibrium of a what? Of a perfect competitor, So we move to the second part of market structure. There are three parts. Are you with me? We move to the second part. So the second part is imperfect market. What did I call it? Imperfect market. Now, under this imperfect market, what are those things we need to see? We have to see pure monopoly, discriminatory monopoly, and monopolistic competition. Pure monopoly, discriminatory monopoly, and monopolistic competition. Then we'll look at short run and long run equilibrium positions. Under that, short run and long run equilibrium. After that, the C part of it, we have break even or shut down analysis in various markets. Break even or what? Shut down analysis in various markets. Break even. When we say break even point is when, are you with me?
Yes, sir.
Your break even point is when your TR minus TC equals 0, or when your TR equals TC. Is that taken?
Yes, sir.
Everything that I'm saying, it is very important. What did I say your break-even point is? It is when your TR minus TC equals 0, or when your TR equals TC. You see that we are still saying the same thing. Don't call this, what did I call this? Break-even. You will notice that TR minus TC, if you bring this minus TC back to this place, it will be what? TR equals, minus return to plus, TR equals TC. So break even is when TR minus TC equals 0, or when TR equals TC. You are still saying the same thing. So what we'll be looking at the break even positions and the shutdown position, or the analysis of break even or analysis of shutdown under various markets. Break even or shutdown analysis under various markets. Now, for those who are watching at home, please can we have the please click on the link. Let me just see what we're having, so that I'll be sure that those who are watching at home, they are getting what we are saying clearly. For those who are watching at home, please, if you can hear us clearly and you can see the board clearly, kindly leave a reaction. That is great. Leave a reaction, and as you're watching us, remember to share this with your friend. This topic is an important topic. It is an important topic. So when we are through with this, we are going to treat some past questions together. We are going to do what? Treat some questions together. Okay, it is sounding very well. Oh yeah, please, can you help me reduce the volume of what you're having with you? So where's the power bank? Okay, just put it here so that I can be monitoring what you are doing. Okay, so please remember to share this with your friends so that we can move forward. Moving forward. So So today we are looking at market structure, and I've written the objective, those things that we're expected to know. Now, what JAMB expects us to do after having all this? What exactly does JAMB want us to know? What do they expect us to do after writing all this? JAMB expects this, and I will list them out one after the other. Now, they expect that you should be able to analyze the assumptions. Please listen, it is not just to know the assumptions. They expect that you should be able to analyze the assumptions and characteristics of a perfectly competitive market. The meaning is we are going to have the assumptions of a perfectly competitive market. That is those things that must hold before you can say that this is a perfectly competitive market. Is that taken? The next one, they expect you to be able to differentiate between short run and long run equilibrium of a perfectly competitive market. So there is difference between short run equilibrium and long run equilibrium of a perfectly competitive market. The next one is that you should be able to analyze the assumption and characteristics of an imperfect market. Analyze the assumptions and characteristics of an imperfect market. You're also going to do the same thing. You should be able to differentiate between the long run and short run equilibria of imperfectly competitive markets. Then we have the last one, which is we should be able to establish the conditions for the break-even or shutdown of firms. So this is when we are saying that, okay, this company is not making profit and it is not making loss. At that point, we call it break-even point, because TR is total revenue. Before we come to this place, we ought to have done revenue concept, which I know I have done. I have taught you revenue concept. Now, TR is total revenue minus CC, which is total cost. So at this point, you are saying that total revenue, which is, let us say, your selling price minus TC, your cost price. You know that now. You know profit is selling price minus cost price, right? So, but here, total revenue minus total cost, when it is equals to 0, it means that a firm is at break-even point. Is that taken? The firm is neither making profit nor loss. In that situation, you can also say that TR equals TC, because when this minus TC jumps to the other side, you have TC. That is TR equals TC. Is that taken? So these are the things that we expected to know under this very simple but beautiful topic. So let us start with the introduction. A market structure refers to the organizational characteristics. It refers to the organizational characteristics of a market. It refers to what? The organizational characteristics of a market. Nobody will ask you the definition of a market structure, but just have it at the back of your mind that a market structure, organization of a market that determine the nature of competition and pricing, organizational characteristics of a market, that determine the what? That determine the nature of competition and pricing within that market. Are you with me? Am I making any sense at all? That determine the what? That determine the nature of competition and pricing within that market. That is what a market structure is. Now, what are those things that separate market structure, or those things that you can say that, okay, these are the features, these are the things that I will see before I can say that this is this type of market structure? Number one, the first of them is the number of buyers and sellers. What did I say?
The number of buyers and sellers.
The number of buyers and sellers will determine the type of market we are looking at. Is that taking? If you remember very well, the last time I told you that when you are talking about poly market, you are talking about what? Seller. If you are talking about Sony, you are talking about what? Buyer. For example, you have Monopoly, Sony. Monopoly is one what? One seller, right? Monopoly, one seller that is selling to a lot of people. Monopoly is what? One buyer that is buying from a lot of people. Are you with me?
Yes, sir.
Are you with me? Are we on the same page? So we said the key feature that differentiates that differentiate market structure include: number one, number of sellers and buyers. Number two, the nature of products. The nature of what? Bless me. The nature of products. What do we mean by nature of products? Are we looking at homogeneous products or differentiated products? Am I making any sense? Are we looking at homogeneous products? Are the commodities in question the same? Or we are looking at differentiated products? Are the commodities in question, are they different from each other? Please, this particular, I think the person has exhausted our data. Are you with me? So please, if I can monitor what we are doing from your, I'll be very happy. Is that taking? So another characteristics, another thing that characterizes the type of market is freedom of entry and exit. What did I say? Freedom of entry and exit. The next one, the degree of price control. The degree of what? Price control. Finally, we have access to information. What did I say? Access to information. So these are what? These are the key features that determine the type of market that we find ourselves. Are you with me?
Yes.
Now, what does JAMB focus on? JAMB focuses on 4 main types of market structure. JAMB focuses on what? 4 main
types of.
Don't look for any other thing. JAMB will not ask you any other question than these 4 main types of market structure. The first one is perfectly competitive market. The second one is pure monopoly. The next one is monopolistic competition. Finally, oligopoly. How many types of market does JAMB focus on?
4.
Which are?
Which
are number one, perfectly competitive market. The next one, pure monopoly, followed by monopolistic competition, and then we have oligopoly. Is that taken? So let us start with the first one, which is perfectly competitive market. What did I say? Perfectly competitive market. But then before we move to perfectly competitive market, before we move to perfectly competitive market, it is ideal for us to know the types of market that we can find ourselves. There are different types of markets in which one can find himself. The first one is factor market. In factor market, factors of production. Are you with me? Factors of production are being bought and sold in factor market. Is that taking? Is that taking? Is that taking? So, it is the market in which the price of various factors of production are determined. The price of various factors of production are what? Are determined in factor what? In factor market. Now, it is a market where the forces of demand and supply of factors determine the price and factor input. So you don't really need to cram that. Just know that here we are looking at factors of production. So a factor market is where prices of factors of production are what? Are determined. And what are the factors of production? Number one, land, labor, capital, and what? Enterprise or entrepreneur. Is that taken? That is number one. Then we have capital market. What did I say?
Capital market.
Again?
Capital.
A capital market is a market for long-term and medium-term securities. It is a market for what? Long-term and medium-term security. It is a market for raising and investing medium and long-term fund. The institution here, what are the institutions in capital market? Listen, the institutions in capital markets are the stock exchange markets and companies. What did I say? The stock exchange market and companies. Those are the institutions in what? Those are the institutions in what?
Capital.
In capital market. Excuse me. Hello. I am having a class here, please. Not that they will hear you. No, they won't hear you. But the noise will be affecting me. So let us move to the next one, please. Hello, please remember to quickly share this with your friends. Share it. You have it on your platform. Quickly share this so that we can have more people benefiting from it simultaneously. So we then look at the next type of market, money market. In money market, whenever you hear money market, it is a market where short-term, listen, this is a market for lending and borrowing in short-term, or for lending and borrowing short-term fund. Are you with me? For investment, you need money for short-term fund. That is money market. Capital market, long-term and medium-term. Money market, short-term. What did I say?
Money market, short,
And medium-term. Are you with me? The major institutions are central bank, commercial banks, etc. Now, what are the instruments that are used? Or better still, the instruments are treasury bills and certificates. Treasury bills and certificates. These are the instruments that are used in what? In money markets. Now, hello, for capital market, the instrument that they use in capital markets are shares and debentures. They are what? Shares and debentures. Shares and debentures. So we move to the next one, which is labor market. Here, we know that labor, people who are working, that is labor according to the definition we have. We know that labor is what? Human effort exerted into what? Into production. So labor market, there is also a market for labor. There is a market for those human efforts. Are you with me? So the market for the human effort is called labor market. This is where the wages and salaries of labor is being determined. So a labor market, in this market, workers and employers are brought into contact. Workers, people who are ready to work, and employers, people who are ready to employ them, they are brought into contact, and wages and condition of work are decided. The wages will be decided in labor market. Condition of work, this is how I want to be working, this is when you'll be working. If you work overtime, this is what you'll be getting. Is that taking? So the wages, this is the amount I'll give you, and the condition of work, this is the condition under which this work will go, will be determined in what? In labor market. So then we have the next one, which will be foreign exchange market. What did I say?
Foreign exchange market.
Foreign exchange market. If you hear that, naira don crash, naira don rise, naira don appreciate, e don depreciate, are you with me? There is iota of foreign exchange in it, that is forex. So foreign exchange market is a market in which foreign exchange is traded. Here, foreign currencies are exchanged for one another. The value of currency can be determined by demand and supply. So for example now, if people are demanding more naira, maybe because they want to come and purchase some things in Nigeria, let us say people are traveling or they are purchasing our commodities from different parts of the world, and they have to buy our naira before they can, are you with me, before they can purchase those things. Now that is, there will be demand for what? There will be demand for naira, and once the demand for naira is more than whatsoever, you understand, once the demand for naira increases, what happens to the value of naira? It increases. Am I making any sense? So once the demand for naira increases, value of naira will increase. That is when naira will appreciate against, or yes, against dollar or any other currency. Do you understand? So that is foreign exchange market. So don't forget that we are looking at what? We are looking at the first one, perfectly competitive market. We are looking at what? Perfectly competitive market. A perfectly competitive market is a theoretical market. Stop. I will explain why it is a theoretical market. It is a theoretical market because there is no market anywhere that is perfect. Is that taking? There is no market anywhere. That is why I clearly state that it is a theoretical market. So a perfectly competitive market is a theoretical market model. It is a market model with the following characteristics. A theoretical market model with the following characteristics. What are the characteristics of a perfectly competitive market? Number one, there are many buyers and many sellers. There are what? Many buyers and many sellers. Are you with me? Go on live class. There are many buyers and what? And many sellers. There are so many buyers and sellers that no single individual can influence market price. In a perfectly competitive market, there is no single individual that can influence or price of commodities in the market because there are so many of them. Are you with me? The next one is homogeneous product. What did I say?
Homogeneous product.
Homogeneous product means that the products are identical. They are almost the same. Homogeneous product means that what? The products are identical. They are almost the same. So that is one of the characteristics of what? Of a perfect market. So all firms in a perfectly competitive market, all firms, what do? They sell exactly the same products. So buyers are indifferent between sellers. So there is nothing like we want to buy this and it is this we are getting. No. Is that taken? So the next one is perfect information. What did I say? Perfect information. There is perfect information about the market. You already know what you are going to meet. You are informed about everything you will see in the market. Are you with me? So all buyers and sellers have complete knowledge of prices and products in the market. But the question is this: has it not occurred to you that you wake up one day and then you go to the market, you already budgeted a particular amount of money, that this is the amount I will buy this thing. Get into the market, you already have information about the market. Get into the market, you then discover that price of the commodity has changed. You will feel like, if it goes up, yes or no? But if it drops, you feel like, oh. But when it goes up, when it is down, is that taken? So in a nutshell, what we are saying in essence is this: there is no single market. I told you that it is a theoretical model, so there is no perfect market anywhere. So the assumption here is that there is perfect information of the market, right? All buyers and sellers have complete knowledge of prices and products in the market. Is that taken? Which is not possible in real life. But the next one is that there is free entry and exit. What did I say?
There is free entry.
There is free entry and exit. So you can enter anytime you like, and you can exit anytime you like. What did I say? You can enter anytime you like, and you can do what? Exit anytime you like. That is free entry and exit. The next thing is that there is now listen to free entry. There is price taker. Price taker. Every firm takes the price that comes, because price is determined by the forces of demand and supply, and that is what we call price mechanism. Is that taking? What did I say? Every firm takes any price that comes to him or her. Why? Because prices are determined by the forces, or by the interplay of the forces of demand and supply. And we already know how that works. When demand is higher than supply, what happens to price? When demand is higher than supply, what happens to price? Price will go up. And now, but when demand is lower than supply, what happens to price? Price will come down, because there is supply, too much of supply. Producer wants to sell, and the demand is not, is not as much as the supply, so price will have to come down. Are you with me? Are you with me? Now, there is no transport cost. What did I say?
There is no transport.
There is no transport cost in perfect market. That is another thing you have to consider. And the next one, finally, is that all factors of production are perfectly mobile. Are you with me? All factors of production are perfectly mobile. You can move resources between one industry to the other one effortlessly. Is that taken? Now, please write this tip down. Write it. The demand curve facing an individual firm in a perfectly competitive market is perfectly elastic. Is what? Perfectly elastic. The demand curve, are you with me? The demand curve facing an individual firm in a perfect competition is what? Perfectly elastic. And what do we mean? It means it is like this. Look at the demand curve facing an individual in a perfectly competitive market. It is an horizontal demand curve. This demand curve shows that this one, look at it, this guy is perfectly elastic demand curve. Is that taken? Is that taken? Another one is that price in perfect competition, price equals average revenue. Price equals what? Average revenue. And average revenue equals marginal revenue. Price equals average revenue. Price equals what? Marginal revenue. So you always see this in JAMB question. Is that taken? Do you understand? Price equals what? Average revenue, and price is also what? Marginal revenue. So those who are watching from home, I hope you understand what we are doing. So we move to the next part. Hello. Now I am trying to put listen to this. I am trying to put two resources together so that you will understand what we are doing. Now, in a perfectly competitive market, consumer is regarded to as the king. Just like what? Just like in a capitalist economy. Is that taking? But then, let us jump into that. So let us move to what we have here. There is freedom of entry and exit, homogeneous goods, perfect knowledge, large number of buyers and sellers, absence of artificial restriction. Add that to the condition. Absence of what? Artificial restriction. There is absence of artificial restriction. There is nothing like this thing. So in a perfect market, there is absence of restriction. Sellers are free to sell and buyers are free to also do what? To buy from any seller. There is nothing like you can only buy from this market or you can only buy from this seller. Is that taken? And there is no preferential treatment. What did I say?
There is no preferential treatment.
There is no what? There is no preferential treatment. No transport cost. Buyers and sellers are price taker. So the buyer is a price taker, the seller is a price taker. Everybody is a price taker. Is that taken? I have explained that. Why is everybody a price taker? Because price is always determined by the interplay of the forces of what? Demand and supply. Price is determined by the what? By the interplay of the forces of demand and supply. So everybody takes the price that comes to him or her based on demand and supply, based on the interplay of these forces of demand and supply. Now let us look at price and output determination. We've already explained that. Hello, we've already explained that. But then let me quickly read through. Now, a perfect competitive firm cannot influence the price ruling in the market. All the firms in the market are price takers. Price is determined by the forces of demand and supply. It should be noted that the industry hands over price to individual firms. The demand curve faced by a competitive firm is a perfectly elastic demand curve. I've already said it. You can see is a what? Is a perfectly elastic demand curve. Means that at the ruling price, all the quantities will be demanded. Any attempt to charge higher price by any of the firm will lead to loss of its customer. So in a perfectly competitive market, if there is a ruling price, that is a fixed price. If there is now a firm that tries to increase the price a bit, that firm will lose its customer exponentially. Am I making any sense? The firm will do what? Lose its customer exponentially. So that is what we are saying here. So the figure below shows, which I have drawn on the board already, right? I've drawn it on the board, so we have it here. So here you should also know that P equals what, everybody? P equals AR equals what? MR. Is that taken? So price equals, so this one will be our origin, our x-axis, y-axis, and this will be our price. Price equals average revenue equals marginal revenue under perfectly competitive market. So in determining the output of the firm, the most profitable, so if they ask you that, okay, profit maximizing output, stop writing and look at me. Profit maximizing output of a perfectly competitive firm is when its marginal cost equals marginal revenue. What did I say? Profit maximizing output of any firm in a perfectly competitive market is when the marginal cost is the same as the marginal revenue. We already know how to find marginal revenue, right? We know how to find marginal cost. Marginal revenue is change in what? Change in total revenue over change in quantity. Right? And marginal cost is what? Change in total cost over change in quantity. So when your marginal cost equals your marginal revenue, at that point, a firm will be said to be doing what? A firm will be said to be maximizing profits. If you remember those that I taught mathematics, when we were doing calculus, You know, I taught you minimum points and maximum points. I taught you that if you want to differentiate, that is, if you have to look for the minimum output or to look for the maximum output, the first thing is that you differentiate first. After differentiating, you do what? You equate whatsoever you have to with zero. At that point in mathematics, in fundamental mathematics for economics, when I was in the university, that was what we were using to determine the maximum output or the maximum price or the maximum output should be the given equation. Am I making any sense? Maybe when we are given equation, for example, they can say that our TR equals, let us say they can say TR equals 4q squared plus 2q, and they can say that our TC equals 2q raised to power 3 minus 14q. Are you with me? Let us say they are giving us this. Are you with me? Now here, I have TR, I have TC here. My break-even point, stop writing and look up. My break-even point is when my what? When my TR equals my what? TC. That is break-even point. In other words, if I want to calculate my break-even whatsoever here, I will say my what? I will say 4q squared plus 2q equals what? 2q cubed minus 14q. This is break-even point. So if I have to continue to calculate, which is not what I want to show you anyways, are you with me? But you need to understand this. Once you have a very strong knowledge of something, others will be very easy. I want you to concentrate. So here, when you bring this, you have 4 what? This and this cannot be together. Do you know why? Because this is square and this is cube. So in a way, this question is wrong. But then if I have to look at, are you with me at all? Though we can still say that, okay, maybe we want to factorize to do, no, we're not going there. But then if I was told to look for the profit maximizing output, I'll just do what? I'll differentiate this. I'll say the TR, the what? The TR, the Q. If I differentiate this will be what? 8Q plus 2. That is the TR, the Q, which is the same thing as what? Marginal revenue. You know, the TR, the Q is marginal revenue. And my for total cost, I will have what? The TC, what? The TC, the Q. And that will be what? If I differentiate, I'll be having what? 6q squared, right? 6q squared minus what? Minus 14. So if I have to do this to find the profit maximizing output, what will I do, everybody? I will then say, this my, don't forget, this will be my TC, right? And my MC rather. MC. So MC equals this, MR equals this. So I will say 8Q, that is the profit maximizing output. So my profit maximizing output will be when MC equals MR, right? What is MC? 6Q squared minus 14 equals, what is MR? 8Q plus 2. So if I have to bring everything together, since this guy is looking like what I know already, it's looking like quadratic equation already. So I will have what? 6q squared minus what? 14 minus 2 minus 8q. Abi, I am not going to solve anything here. I just want to show you what it will lead to. So, but in some cases, in your own case, you will not even need to go this far. Maybe when you are writing post-UTME of schools like OAU, if you are writing post-UTME of schools like OAU, you surely meet it. So here you equate it to 0, right? Because this is already turned into quadratic equation. This and this we turn to minus 16. So you have 6q squared minus 8q minus 16 equals 0. So you can find the values of q here, right? Now, if you find the values of q here, it means, take note of this, you want to find the maximum output or the output to maximize profit. If you want to now find the value of q here, you can use any method of quadratic equation, right? After using any method of, you can use factorization method, you can use what? You can use completing square method, you can use formula method. Is that taken? You can use factorization, completing square, formula method, graphical solution. But everybody will prefer formula method, where you have your Q will be minus B plus or minus root of what? Root of B squared minus 4AC, everything over what? 2A. So we know that our C, we say minus B. So do not let me drag you into this. The moment you find the values of Q, you will then differentiate again because we are looking for profit maximizing output. You then differentiate again. After differentiating again, the reason why you are differentiating again is because the degree of Q after differentiating first time is what? Is more than 1. So after here we'll be having 2 values for Q. We now want to look for the one that will make us maximize profit at all costs. Am I making any sense? So that is what, after you've equated it to 0, and then you have found the root of this equation, you have 2 values. Now these 2 values, you now put them, you plug them into whatever you get after differentiating the second time. So when Q is greater than 0, you know that you're having what? You're having minimum value. When Q is less than 0, you're having what? Maximum value. So the value of Q when it is less than 0 will be what? Will be your maximum value. Am I making any sense? But you are not going there. You are not going there. You are not going there. Okay. Someone said, how are we going to find the value of Q? I have told you already how you are going to find the value of Q, but this question is not for JAMB. Push in there. But then the idea is this. You already know, everybody, which I want you to call us, you already know that to find the profit maximizing output, are you with me? The profit maximizing output of profit maximizing price of a firm in perfectly competitive market, what is the major condition that must be satisfied? Your marginal cost must be equal to what? Marginal revenue. Is that taking? Your marginal cost must be equal to what? Must be equal to marginal revenue. Is that taking? Don't forget that price equals marginal revenue at this place. Price equals average revenue. Price equals marginal revenue. So at this point, your marginal cost must be equal to your what? Marginal revenue. Since price equals marginal revenue. Is that taking? Do you understand? Am I making any sense at all? Good. So let us continue. Now, I am putting 2 materials side by side so that I will give you the best. I will not leave one place and touch one place and then leave the other place. Now, long run equilibrium of a perfect competitor. Long run equilibrium. What did I say? Eniola Victor, I can see that you are trying to follow us. So, who is Eniola Victor? Okay, Eniola Victor is not here. Not you. Eniola Victor, if you are lost at any point, please let me know. Let me know. So, since you understand this, just know that the major reason for all this is just because of this thing. Is that taking? I only showed you what we used to do when we were in the university, only to find the profit maximizing output or to find the profit maximizing price. And then it was always interesting. It was always interesting. I enjoyed every moment, every bit of it. That is why I am still doing it till today, and I'm enjoying it the more. Now, long run equilibrium of a perfect competitor. Please, I want to be sure that everybody can hear me at home. So please, can you help me monitor it? Now, in the long run, perfect competition always tends towards normal profits. Perfect competition always tends towards what? In the long run. In the long run, perfect competitor always tends towards what? Towards normal profits. The reason is this. Hello, are you with me? I want you to listen very well because you'll be seeing all this in your past question. Are you with me? Now, if firms earn supernormal profits, if a firm is, listen, very simple. Let me bring it down to one small, like to your local environment. Are you with me? Let me bring it down to your level in your local environment. Let us say you see a woman. You just saw a woman just last year. The woman started selling pepper. beside the street. Listen to me, oh. Kebale Mokota and so shut up and listen to me. Just last year, a woman started selling pepper beside the street, as we are going. And then notice that after 1 year, the woman has made a lot of money. Already she has started driving Benz up and down, and she's still selling pepper. Now the question is this: what do you think will happen? What will other people do? They'll start selling pepper. Abi, they will run into the business. Why are they running into the business? They are running into the business because they see that there is supernormal profit in the business. Am I making any sense? So if firms earn supernormal profit, new firm enter the market. And when new firm enter the market, this one is supplying, this firm is supplying. There is another new firm supplying. What will happen to the quantity supplied? Talk to me. It will do what? It will increase. So when quantity supplied increase, what happens to price? Talk to me. When supply increase, price might drop. Is that taking? Price will fall. And so as price is falling, what will happen to supernormal profits? It will disappear. Show to you there. Anything easy. So in the long run, there is what? Every firm, every perfect competition tends to always make only normal profit, not supernormal profits. Are we on the same page? Are we on the same page? Are we on the same page? So we move to the next one. We are looking at long run equilibrium of a perfect competitor. The next one is if firm makes losses. If firm makes losses, what happens? Firm will exit the market. Tẹ́bárí téèyàn kan gbé business kan, bóyá ó gbé gba pure water, sorry, ó ní pure water factory. Ìgbà tó bẹ̀rẹ̀ pure water factory yẹn, ṣé ń gbọ́? Long run equilibrium. Long run what? It is long run equilibrium. Long run equilibrium. Equilibrium. I started with all this before we long run equilibrium. Are you with me? I hope I've answered you, Victor Eniola or Eniola Victor. Great. Long run equilibrium. Great. So, if firm makes losses, firm exits the market. Are you with me? Supply decreases, price rises, losses are eliminated. Let me explain that. You saw that someone started pure water factory business. Are you with me? Or maybe let us put it this way. 5 people in the same environment, they started pure water business. As they started pure water business all together, all of a sudden, all of them started making loss. They all started making losses. Guess what? Some firms will do what? Those firms who cannot afford to continue, they will do what? They will shut down. They will do what? They will shut down. When they shut down, don't forget that because all of them were in the market, supply was high. But the moment they shut down, what happens to supply? It reduces. Now that supply has reduced, what will happen to price? Price will increase. Why is price increasing? Because the demand that we have may be what? May be close to supply or will be higher than supply. So now, price will do what? Will increase. Now, as price is increasing, profit will be what? Will be made again. So what we are saying is this, that in the long run, irrespective of what the case is, in the long run, irrespective of what the case is, a perfect competitor will always make a normal profit. We are sorry for that little glitch. It happens. We are sorry for that little glitch. It happens once in a while. We are sorry. Our prayer is that God should give us extra money to buy better phone, so that we'll be using that phone, that nobody will have the number. We'll be using that phone to stream live, and then this other phone, we can use it for our business. So it is possible that we will just see a situation where the thing will be rolling and I'm not through with the class. Just know that I am still I don't have two phones. So let us continue, guys. Let us continue. Now, the equilibrium condition, the conditions that must be met for equilibrium to occur. Are you with me? Number one, marginal cost must be equal to marginal revenue. Are you with me? Marginal cost must be equal to marginal revenue. That is the first condition. The second condition is that marginal cost should cut marginal revenue from below. What we mean is this. Let us say we have a graph. Look at the second one, so that you not make mistakes. Àwọn ibi tí àwọn teacher wa kankan tó máa ti ń get it wrong lélẹ̀ tó máa ń jẹ́ kí kíní ẹ̀ le fún wa. Am I making any sense? Now, look at this. Let me say I have this curve. On a norm, we know that our marginal revenue, what? How will our marginal revenue be? It will be going down, Abi. Marginal revenue will be going down like this. As marginal revenue is going down, marginal cost curve must cut marginal revenue curve. Are you with me? At the lowest point. Understand? Do you understand? It must cut it at the what? At the lowest point. So the marginal cost should cut marginal revenue from below at the point. Is that taken from below at the point? So what we are saying is, let's say you have, let us see, this marginal curve, and this will be your marginal. See, on the norm from this is what we are looking at. This is the particular one we are looking at. So if you have it this way, your marginal cost should cut it like this from below. So this is, your MR equals what? Equals AR equals P. So this is your marginal cost. So it will cut it from below at that point. Abi, you remember that I told you that P equals AR. So this one is your marginal revenue, is your marginal what? Is your marginal revenue, your average revenue, and your price. And this is your what? This is your marginal cost. So it's more any point. So bad till it cuts to marginal revenue, marginal cost till it cut marginal revenue from below. At that point, you say that the firm is at equilibrium. Are you with me? Are you with me? Okay, please, can you confirm if the network is okay now? Please, can you reload it? Okay, sorry, we are back, live and direct. We are back live and direct. Sorry for the glitch, it happens. Yeah, sorry, you are welcome back to Nigeria. Sorry, this is Nigeria for you. This is where you pay for data, and then they will tell you that there is no network. If I was in the UK, I would have MTN for don't pay. What it tell you'll be having class like this that you have paid them for. They will not tell you that there is error in network. Are you okay? Are you kidding me? You understand? You cannot be kidding me. So now let us move to this. Hello. So I hope you understand what we are trying to say here. Now, but the question is, hello, please take note of this. Write what I want to tell you. Here I am not just teaching you from just got one material and then I'm using it too. No, we are trying to bring different materials so that I will a question from anywhere based on the fact that it is what I have done. You already know what to do. Now, what is long run equilibrium? What is long run? Now, the long run period or the long run is a period in which all costs vary with the level of output. What did I say? Is a period in which all costs vary with the level of what? Vary with the level of output. So in the long run, all costs vary with the level of output in the long run. So it is still in this long run that firm can vary with the level of output. Please, it is still in this long run that firm can do what? They can adjust the scale of production. What did I say? In the long run, firm can adjust their scale of production. Write that. Scale of production, large scale, small scale. It is in the long run that you can either choose to go large or choose to come low. It is in the long run that firm can adjust their scale of production. I mean, so yes, scale of operation. So in other words, to enjoy the abnormal profits, new firms are likely to enter the market. With the entrance of new firm, supply will increase and price will fall. So we've explained all this. I've explained it. Is that taking? Wait, before we continue, are you confused? If you are confused, raise up your hand. At where? Where exactly? Oh yeah. Those watching from
Scale of production.
Scale of operation. Yes, operation. I said production, but that was a mistake. I repeated it and I made mention of operation. And I've explained what we are trying to talk about when we talk about scale of operation, right? You can choose to go large, you can choose to go small in the long run. I've explained everything you need to know. If there is supernormal profit, are you with me? Or abnormal profit, as you may want to call it. If there is supernormal profit, new firm want to enter, yes or no?
Yeah.
When new firms enter, what will happen to supply? Supply will increase. When supply increases, what happens to price? Price will drop. So when price drops, what happens to supernormal profit? It will disappear. Are we making sense? So I'm just looking for every possible thing, every possible means to explain this. And we are going to touch on everything properly. Now, in the long run too, are you with me? Hello? There is also the possibility, not in the long run, there is also the possibility of a firm to make loss. When does a firm make loss? In a perfect market, a firm can make abnormal profit or loss. Abnormal profit is this. Are you with me? Abnormal profit situation has been we've talked about abnormal profit situation, right? Why they make abnormal profit, right? Now, let us consider its loss. A perfect firm will be making loss if the price is below the average cost. Look at it. This is when you make. See, this is when you make loss. Let me draw it on the board so that you don't make mistake. Can I clean this?
Okay.
Can I clean it?
Yes, sir. What's the price?
It's below the average cost. Average cost is cost of producing one unit. Hello, stop. Everybody stop. Let me explain that so that you not make mistake. I want you to have a clear understanding of what we are doing. Let us say I am a producer of marker. The amount of money that I spend on producing one of these markers is 250. That is my that is my average cost. The price of producing a marker is what? 250 average cost. But then if my price now drops below 250, I'll be making loss. Abi now, if my price drops below 250, what will I be making? I'll be incurring loss. So in the long run or in the short run, anytime, even as much as your price is below the average cost, you'll be doing what? You'll be making loss. And that is represented by this diagram. Look at it. Look at the diagram here so that you understand what we are saying. Let us say this is our price. Are you with me? You know that our what? Our price equals average revenue equals marginal revenue. Abi? Now we have an average curve. The average curve now goes like this. Look at our average curve. Which one? This is price. So look at this average curve and price. You can see that price is under average curve. Am I making any sense? Price is under what? Average curve. Average cost rather. It is under the average cost curve. So at this point here, the firm is making loss because this is price. Are you with me? And this is average cost. So this price is under this. They are not all intersect or meet. Are you with me? Am I making any sense? That is the point whereby a firm makes what? A firm makes loss. But don't forget, our marginal cost, we always do what? It will always cut the average cost at the lowest point. Is that taken? So for that reason, you can have this. This is marginal cost. Am I making any sense at all? So don't be confused. This is, at this point, there is loss. You get the logic, but hello, do you understand it? I understand the graph. Raise up your hand. Those of you who are watching, if you understand the graph, please let me know. Eniola Victor, do you understand the graph? Onidawola Pelumi, do you understand the graph? You don't understand the graph? What now? This is average cost graph. This graph like this is average cost. And this place is our price. This our price is the same as our average revenue. It is the same as our marginal revenue. But you can see this price, it is under this. It is not close to it. It is not meeting it. So if this is not meeting this, if your average cost cannot be at least your price, you will be making loss. Abi, or produce nǹkan fún, let's say, o fi 300 naira produce nǹkan, ìgbà tó wá fẹ́ tà torí pé àwọn èèyàn tó ń tà ti pọ̀ jù, o wá ń tà ní 200 naira. So make, o mọ̀ pé iye tó fi produce ẹ̀ ní average cost, iye tó ń tà ní price. Tí o bá fi lè ṣẹlẹ̀ bẹ́ẹ̀, wá notice wípé o make loss nìyẹn, and that is what we explained with this average cost curve wà lókè, price wà nsàlẹ̀, wọn meet ara wọn rárá. That is what? That is loss. Do you understand?
Yes.
Do you understand? Please, I want you to confirm that we are on the same page, that we are making sense. Everybody, please, is the network okay?
Yes.
Very okay, right? So we move, and we move with the speed of light. We move in the strength of the Lord of hosts. Who does not understand? Who does not understand? Does not understand. What exactly is it that you don't understand? Can you please, Eniola Victor, I remain calm. Everything we've done is very simple. You know, the beautiful thing about this video is that you can always watch it again. This is not like your regular TikTok video that you can only see highlights. Is that taking? This is a great platform. In fact, kudos, not even kudos to YouTube for this. You can always watch your live, so you can always go back to watch it. What I've just said is this, so that you will see it again, is that this is your average cost, this is your price. Your price is not even close to your average cost. Are you with me? Since your price is not close to average cost, you are making loss. You produce something for, let's say you produce one of this marker, you produce one of each of this marker, each average cost of each 300 naira, each of these 300 naira. Now you are now selling it for 200 naira, average cost 300 naira. Okay, lower, you are now selling it for 200. You are making loss. Is that taking? Yes. So we continue. Reason why examples of perfect competitions are not common. Hello, why you know, I told you that perfect competition is just a theoretical model from the onset, right? Yes. So what are the reasons why perfect competition is not common? Are you with me? Perfect competition is not common because it might not be possible for all firms in the market to have perfect knowledge of the market. It might not be possible for what? All firms in the market to have perfect knowledge of the market. The price that they charge may not be the same. There is possibility of slight variation. You know, in a perfect market, we are talking about homogeneous commodity. That is, there is little or no differentiation of products. Are you with me? So now that you have the same commodity that you are selling, and then prices are different, so it is possible that you may be saying, has it not occurred that I am not advertising for this, that's why I'm covering their name. This power bank that I'm holding like this, the amount I got it, it's still in the same market, or this same market. I will go to, when I bought this for 65,000 naira. Going to another store, I saw it for 70,000 naira. Coming to another store, I saw it for 60,000 naira. Power bank, the same market, the same products, different prices. So it is possible that even the same product in the same market might attract different prices. That is the reason why we can never say that, okay, there is perfect market. Another reason is that the condition of product homogeneity may not be real. Hello, product homogeneity may not be real. The quality, see, they can make an adulterated version of this. Only she fake it. Look at this board that we are using. This is an imported board, but they called it an imported board, made in China, not China, made in China. But Omoina can do it, and then it will be made in Bana. Maybe a banner. You understand? A bar. Do you understand? So they can make adulterated version of this. So product homogeneity is just a mirage. Is that taking? It is just a mirage. Product homogeneity. Let me ask you, iPhone 13 and iPhone 13 Pro Max, are they the same? Perfect. iPhone 12 and iPhone 13. You understand? They are not the same. Do you understand what we are talking about? So those are the reasons why you may never say that there is perfect competition. So let us move to imperfect markets. We cannot cover all this for today. So there will be need for us again. We have to finish this topic this week so that we can continue. So do we agree to meet tomorrow?
Yeah.
They'll be having physics on Sunday. Yes, they'll be having physics on Sunday. So we cannot have double, like I cannot be streaming 2 classes simultaneously on the same channel. Are you with me? So should we meet tomorrow? Now, if you are going to meet by tomorrow, by God's grace, we should be looking at maybe from 4 to 6. Or maybe some of you choir members in the church. And those who want to cook at home, that in fact those choir members, do you understand, guys? Don't worry, that is how we just take. But then we have to agree on a time to come. We have to complete this. So, but then when we are through with the class, we will continue. Now let us talk about imperfect markets. Hello. Before we continue, what did I say perfect market is? We said it is a type of market that is characterized by what? Oh yeah, tell me those characteristics. Open your book and tell me be fast. A market that is characterized by what? Just list them. Characterized by what? Number 1. Many buyers and sellers. Number 2. Homogeneous products. Number 3. Perfect information. Number 4.
Free entry and exit.
I can choose to enter anytime and exit anytime. Number 5.
Price taker.
No, everybody is a price taker. Yes, everybody. Buyers and sellers are price taker. Why are they price taker? Because of price mechanism. And price mechanism is what? The interplay of the forces of demand and supply. So it is the demand and supply that determines the price. So everybody is a what? Everybody is a price taker. So we move to the next one. What is the next one?
There is no transport.
No transport cost. They did not include transport cost. Another one is that there is what?
All factors of production
are mobile. Abi?
Yes.
All factors of production are what? All factors of production are mobile. What is the next one? There is no form of restriction. There is no form of what? Restriction. Do you understand? So now let us move to imperfect market. So when we talk about imperfect market, what comes to your mind? Now look at perfect market. There are many buyers and sellers. Here there may be few buyers. Here there may be few sellers. Is that taking? Am I making any sense? Here there may be restriction of entry. For example, in monopoly generally, there is restriction, like you cannot just enter anyhow. Are you with me? Are you with me? You can never have perfect knowledge of the market. Am I making any sense? Am I touching your heart? Am I speaking the heart of God for you?
Yeah.
Oh yeah, where are we getting it wrong? Gadia Pese. Yeah, with us. Now, imperfect market are markets where at least, hello, they are markets where at least one of the conditions of perfect competition is not satisfied. You know the condition of perfect competition are which we just listed. So any market where one of the conditions that we listed in perfect competition is not satisfied, that is what we call what? That is what we call imperfect markets. Maybe there is no freedom of entry and exit. Can you reduce that a bit? Maybe there is no what? Maybe there won't be freedom of entry and exit. That condition is not satisfied. So if it's not satisfied, it then means that it is what? It is an imperfect market. Maybe there is no perfect knowledge of market. That is what? That makes it an imperfect market. Maybe there are just few buyers or few sellers. Are you with me? That makes it an imperfect market. So any market where the condition, any market where any of the conditions that we listed under perfect is not satisfied, then we call that market an imperfect market. We call it an imperfect market. So the first imperfect market that we want to look at is pure monopoly. Kí ni mo pè é?
Pure monopoly.
Do you play Monopoly, that game? What did you notice about Monopoly? Before we talk about Monopoly, before I go into the details, what if you play Monopoly at home very well? Raise up your hand. If you play it, have you played Monopoly, that game that they call Monopoly? You will notice that in Monopoly, hello, listen, hello, look at what Monopoly looks like. I want to use this example to bring my point home. This is, let's say this is the card, this is the board, and on the board, let us say there are different markets or different property, they call them property or assets. If you are the one who bought this, anybody who lands here must pay for it. So even if there are 20 players playing, any asset that you purchase, that you bought, and it is your own, anybody that uses that asset at that time must pay for it. So you are the only owner of that type of asset. That makes you a what? A monopolist. Do you understand? Let us say you have hotel here. You have one hotel here. Anybody who is coming and the person mistakenly enters this place, the person will pay for that hotel. Let us say you have to charge $500 for that hotel. The person will pay that $500. Let us say there is a library here. Let us say this is hotel. There is a library here, and you charge $20 for that library. Everybody will pay. They are just telling you that that in as much as you are the owner, irrespective of the number of people that are playing, you are the only one they will pay to. That is why they call the game Monopoly. Am I making any sense? Am I making any sense? So, what are the characteristics of imperfect market? Number one, there is few sellers and buyers. Number two, there is heterogeneous commodity. You know, in perfect market we have homogeneous. Homo is one, but in imperfect market there is what? Heterogeneous commodity. Number three, there is no free entry and exit. There is no what? Free entry and exit. Number four, there is lack of information. You can check the video later. There is what? Lack of information. There is lack of information. Number five, immobility of resources. You cannot move resources anyhow. Hello, you cannot move this your guy from here to this place. You can't move your resources. Immobility of resources. There is preferential treatment. In perfect competition, no preferential treatment. Everybody receives or gets the same treatment. But in imperfect markets, there is preferential treatment. Are you with me? So, let us talk about the first form of imperfect market, which is monopoly. Monopoly itself has a lot to dig into. Are you with me? What did I say? Monopoly itself has what? Has so many things to dig into. So let us just go straight to monopoly. Don't forget, when you hear monopoly, just know mono is one and poly is what? Seller. Whenever you hear mono, just know it's one, and then poly is seller. Now, monopoly is a market structure in which a single firm is providing a product for which there are no substitutes. Listen, there is a single firm offering products without close substitute. Without what? Close substitute. That is, you can't get anything substitutes. You can't get close substitutes. For example, when there was NEPA, it was monopoly. Even till now, our IKEDC, it is still monopoly. There is nothing like anybody getting it. Is that taking? the product you are offering or the product you are selling, there is nothing like, okay, maybe there is another person who can offer that same service. At a point in time, Indomie noodles, House of Dufil, they enjoyed what we call patent right. Are you with me? This patent right made them the monopolist of noodles in Nigeria. Are you with me? This patent right made them the what? Monopolist of noodles for like 15 years. There was no other firm that could produce noodles. Why? Because of the patent right. And as at that time, there are no close substitutes. Am I making any sense? So, listen, the firm can control the price. Or, listen, another thing to take note is the firm cannot control both price and output. Oh yeah, now I want you to listen. It's not all about writing notes. The firm under monopoly cannot dictate, it cannot control two things. It can't control price and control output at the same time. It can only control either price or output. A monopoly can only control either price or output. If it's controlling price, it cannot control the number of whatsoever people will buy. If it's controlling the output, are you with me? It cannot control the price. Am I making any sense? Am I making any sense? So a monopolist is a single producer or a seller of commodity which has no close substitute. The monopolist is the only firm in the industry and there are no competition from other firms. He is regarded as price setter. He is regarded as what?
Price setter.
So a monopolist is a price setter. He sets price, but he cannot dictate output. So he's regarded as price setter and not a price taker like perfect competitive market. He's a price setter. He sets price. He's not a price taker. You know, a perfect competitive market, it is the forces of demand and supply that will set price. So every other firm will take the price that the forces are dictating to them, right? But a monopolist will set price. So if he's setting price, he cannot dictate the quantity. Do you understand? Do you understand? Do you understand? An example of monopoly, like I explained, National Electric Power Authority that we had then, that later metamorphosed it into Power Holding Company of Nigeria, PHCN. It was NEPA, then from NEPA to PHCN. From it is now IKEDC, Abi Ikeja Electricity Distribution Company. Is that taking? So they are still monopolies because it is not like MTN and Glo, not like our telecommunication that you have MTN, you have Glo, you have Airtel, you have Etisalat. If MTN is doing Yama, I'll switch to Glo. If Glo is doing I'll switch to Airtel. If Airtel is doing I'll switch to Etisalat. Am I making any sense? So, what are the characteristics of a monopolist? Number one, what are the characteristics of monopoly rather, of a monopoly market? One single producer or seller. What did I say? One single producer or seller. There is just a producer, there is just a seller. That is number one. Number two, product has no perfect substitute. You know the meaning of perfect substitute, right? So product has no what? Perfect substitute. Number three, there is restriction on entry and exit. There is restriction on what? Entry and exit. There is restriction on what? Entry and exit. Number four, immobility of labor. You know, I've explained all this before, right? Labor cannot be moved. Are you with me? Immobility of labor. Human resources are not allowed to move freely in this market. So if you are here, since that is the only market, are you with me? You cannot move from this same place, from this firm to another one, because there are no other ones. Is that taking? So there is immobility of labor. I want you to take note of this. Profit maximization. What did I say? A monopolist will always maximize profits. Why? The main goal of a monopolist is to maximize profits. A monopolist can maximize profits in the short run and long run. Only maximize profit in the short run. When we say short run, in the short run, Are you with me? Some factors of production are what? Are fixed, while some factors of production are variable. In the short run, please take note of this. Anybody to saw another thing, that is how I teach you. Another thing, I will tell you what you will see again. In a topic, I'll be teaching you another topic that you need. In the short run, short run, SR, some factors of production will be fixed, while some factors of production will be what? Variable. But in the long run, all factors of production will be variable. Is that taking? Is that taking? Am I making any sense at all? Great. So we move to the next one. Are you with me? A monopolist is a price maker or a price setter. He's not a price taker. He does not take price. He's the one who sets price. Because he said he can either do what? He can either set price or set quantity. So either way, he's still setting price. If he's to set the quantity, to reduce the quantity to first supply. If he reduces the quantity that he wants to supply, invariably he's shooting the price up. Am I making any sense? If he reduces the quantity he wants to supply, what is he doing? Invariably, he's shooting the price up. And if he chose to shoot the price up, he knows that I am reducing the quantity I'm supplying because I cannot have both. I cannot have what? I cannot have both. Now, what are the things that can cause monopoly? Àwọn kankan wà tó kó máa fa monopoly. You know that a monopoly is a situation whereby there is just a single seller and plenty buyers. So kí ló lè fà tó yẹ pé what can actually happen that will make that you now have just one seller in the market? What is that condition, or what are those conditions? Number one, granting of patent rights and trademark. I gave you example of which company? House of Dufil, Indomie. An example of Indomie. They were given patent rights. That because now, listen, those of you who are doing business studies, hello, listen to me. Patent right, it is the right that a particular organization gives, or maybe gives a particular firm, because they are the first to ever think of producing something like that. So for them to get the benefit of their innovation, government will protect them for a period of time that no other firm can come into this market to compete with you. That is patent right. So when Indomie or when House of Dufil came in with the idea of noodles and they called it Indomie noodles, government looked at it that during those times, the created like the what kind of food? The Oyibo like food that we used to eat, that was just rice. And rice, we used to eat it just during Christmas or New Year. It now got to a stage where, at a point, rice was not becoming popular. We now started eating rice only on Sundays. About the glossy church, we will not eat when we were going to church. So whenever we were back from church, our mother would have cooked rice and shower fish. She cut the fish into maybe one slice of fish. She will divide it into like maybe 20. Now she will now give you that fish. She will tell you to put the fish in your left hand. You must finish the rice before you finish the fish. Are you with me? You must finish the rice before you finish the fish. So for that reason, till today, if you have noticed, anyone who has eaten with me before among you, you will notice that I will finish the food until I eat fish. Although my meat is always big now, but I will finish that food because it is already part of me. I don't know how to go away from it. That is why the Bible says, train up a child the way he should grow, so that when he's grown, yes, I know you like child, but I like child. Train up a child the way he should grow, so that when he's grown, he will not depart from it. My mother trained me to always put my fish in my left hand. I must not eat it. I must finish the food. You don't understand? And it is still like that today, although I don't put my meat in my left hand. There was even a time that I tried to eat the fish before the meal. What happened? I became disinterested. I just dropped it, and then we don't take the topping before we finish the meal. So, are you with me? So granting of patent rights and trademark can cause monopoly. I gave you a very good example even before we got here. The second one is acquisition of merger of firms. Are you with me? For example, let us say, look at it. Let us say I have a business. Okay, look at, we have Akadais, a tutorial center, and in the long run, I just decide to start buying all tutorial centers in Ikorodu. I just want to buy up all tutorial centers and paying tutorial centers owner very good money that I want to buy it up. It will get to a stage that there will be no other tutorial center in Ikorodu. It will only be what? Akadais. And what is that? That is monopoly. Another measure that you have also seen recently is some banks coming together. Imagine that all the banks now come together and turn to one. There will now be what? Monopoly of commercial bank. Is that taken? Now the next one, are you with me, is cartel. A good example of cartel is OPEC, Organization of Petroleum Exporting Countries. OPEC is a cartel. Am I making any sense at all? They control the market in a way that there will be no non-member will be able to supply or sell their products to some countries. That is monopoly. Am I making any sense? Another example is Act of Parliament. The Act of Parliament, that is the judgment passed by the legislative arm of government, can actually cause monopoly. How? Another major cause is when there is monopoly power on an organization. Are you with me? When the law of a nation confer expressly monopoly power on an organization, such firm will be given the sole right to produce the product, and new entrants are prohibited from entering the industry. A very good example is Loma. Are you with me? This Loma that you are seeing, Lagos State Waste Management Authority, they did not just start. Have you seen any other waste management authority in the state? No, because they have monopolistic rights. Are you with me? There is an act of parliament that confers that right on them, that they should be the only provider of that service. Another one is professionalism. There are some professions that just because of your level of education in that field, you will have to come together, and then there is no other person that can come in. Are you with me? In the midst of accountants, you cannot find a job if you are not an accountant. Am I making any sense? Another one is control over supply of raw material. If you have control over the supply of a particular raw material, you'll be a monopolist. And there is another one, economies of large scale production. The benefit you derive from having large volume of productive capacity. Are you with me? The benefit you derive from increasing your volume of productive capacity, that is economies of what? Large scale, whereby your output will increase, but your cost of producing a unit of that commodity will drop, and you'll be making profit. Economies of large scale of production. The next one is state monopoly. Are you with me? State monopoly. Government of a nation may embark on production of a particular goods, and when they embark on the provision of that goods or services, there is no other person that can come in. For example, railway. Do you have money to start your own railway? So it is only government that can have that. Am I making any sense? That is state monopoly. Level of technology can also create monopoly. The level of technology that an organization or a firm or a country has can make every other body to come and be getting whatever they want to get from that organization. Level of technology. Finally, effective advertising strategy. If you know how to advertise very well, see, if you have someone who knows how to advertise working with your organization, people will be. I remember that there was a tutorial center around that area. The tutorial center already moved. Very poor, very posh tutorial center. You enter, you act by Sisori, and then we were inside the Ruku. But because God has helped me to advertise and to show result that this is what we are doing. Whenever I got to that place, whenever I was just doing my own, I was just doing my own publicity. Law, are you with me? I was just doing my own publicity. Your sister is calling. I was just doing my own publicity, and as I was doing my publicity, what is happening? People are seeing. They saw that tutorial center. They did not even know there is one tutorial center there. That place, they said they are good advertising. So before you know it, what happened? If you cannot withstand the competition, you do what? You shut down. Am I making any sense? Am I making any sense? So we move to the next one. Equilibrium of the monopolist. Are you with me? Equilibrium of the monopolist. A monopolist will be at equilibrium. When will a monopolist be said to be at equilibrium? Monopolist can be said to be at equilibrium when the same thing is applicable here. What happened to a perfect competitor will also happen to a monopolist, because he will also be looking at a place where it's marginal cost because it's marginal revenue. Are you with me? But we are going to take so many diagrams, and on this note, based on the fact that we have eaten deep to our time, we shall continue tomorrow by, let's make it 12 p.m. That would be great, right? So from 12 to 2, that would be great. Is that taking 12 to 2? So thank you for your time. Thank you for staying. God bless you. And if you are just seeing us for the very first time, remember to subscribe to the channel. Share this video with your friends. Psalm 18 verse 28, everybody. For thou will light my candle. The Lord my God will enlighten my darkness. For thou will light my candle. The Lord my God will enlighten my darkness. For thou will light my candle. The Lord my God will enlighten my darkness. Don't go. Hello, please don't go. Help me pack. Emma Loejo. I know that you have tried. It is not easy. Help me pack my property together. Help me put my property together. All my laptop, bench, everything. Abila Eniola, don't go. Come help me put my things together. Arrange them properly so that I will not be struggling after I've helped you. Yes.